Bismillahirrahmanirrahim. Assalamu alaikum. I am Sayyid Akif Shah, Lecturer Finance at Institute of Business Studies, Kohat University of Science and Technology. The title of this course is Business Finance, and the course code of this subject is BS 151. This is our lecture number 15, and the broader topic we have started is time value of money, under the umbrella of which we will be discussing how to calculate present value of annuity due in this lecture. The outline of this lecture will explain the types of annuity, and then specifically we will be discussing the present value of annuity due. So dear students, after listening to this lecture, you should be able to understand what is meant by annuity due, and secondly, the main point agenda of this lecture to understand how to calculate present value of annuity due. As we have already explained that an annuity represents a series of equal payments or receipts occurring over a specified number of equidistant periods. And there are two types of annuity. One is known as ordinary and the second one is known as annuity due. The difference is at the end of the period and at the beginning of the period. The agenda of today's lecture is to focus on annuity due and specifically how to calculate the present value of annuity. The steps or protocol to solve the time value of money problem are once again same. The most important, read the problem thoroughly and carefully, then create a proper timeline, then to put the cash flows and arrows on the timeline, determine if it is the present value or future value problem, then to determine if the solution involves a single cash flow, an annuity stream, which is the point agenda of today's lecture, or finally a mixed flow, which we will discuss in the final lecture of time value of money. Solve the problem, and then we can finally check out with the help of financial calculator that either we have calculated correctly or wrong. Let's take a numerical example over here to explain how to calculate the present value of an annuity due. So let's suppose an investment opportunity, which is annuity due, clearly mentioned in this question or numerical case, is asking you to deposit $1,000 for how many years? For the next 3 years in bank A. It means N over here is 3. The number of years you are required to pay out the same equidistant payment is 3. And the payment which you are going to invest in this annuity is $1,000. And the equidistance is yearly basis. So at the start of each year, we are going to invest $1,000 in this bank account, which is annuity due, a bank account and investment opportunity, which is an annuity due. And this investment promises you to pay 7% compound annual interest rate. It means that between investor and the bank, 7% compound annual interest rate has been decided. If the discount rate prevailing in this case is same, discount rate means it's a hint. As previously I have explained that if in a numerical question the word discount rate has been mentioned, then it will be a click or a hint to you that the question is asking to find out the present value. It could be simple present value or it could be present value of an ordinary annuity, or it could be a present value of annuity due, like in this case. So the discount rate is once again same as the compound interest rate. And the question is asking you that what will be the present value of this annuity. After thoroughly and carefully studying the numerical case, we have drawn a timeline. It is an annuity due case, and annuity due means that you as an investor is going to invest your money at the start of the period or beginning of the period. The timeline 0 depicts or explains the today's time or today's date. This is the time you and the bank has decided to invest in the investment opportunity, which is annuity due, and you have decided to invest $1,000 into this bank account or annuity based bank account, and the maturity date decided between you as an investor and the bank is the third year, that is n is equal to 3. At the end of third year, you are going to receive certain number of dollars from the bank upon your this investment opportunity. So you have correctly mentioned the cash flows, beginning of period 2, beginning of period 3. This first year starts from timeline 0 and end at this point. And after the first year completes, this is the point which has already been explained with this arrowhead, that it is the beginning of period 2. It means that this is the beginning of second year, and this is the beginning of third period, which is the third year in this case. And these are once again the equal cash flows, each one period apart from each other, and the period of time in our case is 1 year. After correctly manufacturing or designing the timeline, we need to draw the arrowheads to find out the present value of annuity due. In order to calculate the present value, we need to discount all the cash flows and bring them back to the time 0 or the day today we are going to invest our money, and we are interested to find out the present value of this annuity due in today's date. So the amount you are contributing at time 0, which is 1000, will remain the same as it is because there is no compounding or discounting effect. The today's 1000 is actually equal to the $1000, and there is no compounding or discounting impact. The $1000 you are going to pay at the start of the second year needs to be discounted back at time 0, and the compounding impact will be only 1 year apart from or at distance of time 0. Similarly, the amount you will contribute at the start of third year, that is the end of second year and the start of third year, is once again $1000, and this $1000 needs to be discounted back at time 0. So one jump, and then once again needs to be discounted by using a simple present value formula, or another way around you can use the mathematical expression to discount this value in one go. So dear student, there are once again 3 methods to calculate present value of annuity due. Number 1 is the formula method, which has been clearly mentioned in this octagon yellow color shape. The formula for calculating the present value of annuity due subscript n is equal to the cash flow, first cash flow, divided by this slash is denoting that it is a division. 1 plus I is a compound rate, which is 7% in our case, raised to the power 0. The reason for this 0 is that you are going to discount the first cash flow at today's date or today's time, and this has no compounding or discounting impact. So the 1000 will remain as it is because anything raised to the power 0 is actually 1. So therefore 1000 divided by 1, the resultant value will be the same $1,000. This is our second cash flow, which needs to be discounted with raised to the power 1. And this is our third cash flow, which needs to be discounted with raised to the power 2, so on and so forth up to n minus 1. Or another way around, you can use the simple formula of present value of annuity, ordinary annuity, and then needs to multiply it with one additional factor. The reason is you are going to invest your money at the start or beginning of the year. Therefore, an additional 1 year factor, compounding factor, needs to be multiplied by with the calculated value of present value of ordinary annuity. If you are not interested to use or remember this formula, so you can do it with the help of simple ordinary annuity, and then at the end the resultant value needs to be multiplied by with this additional factor. So example of an ordinary annuity, we have just put our $1,000 on the timeline and also mentioned the 7% compound interest rate. This 1,000 we have invested in today's date remains as it is. At the start of second year, we are once again going to invest 1,000, which needs to be discounted back with the help of this formula, and it will give $934.58. Similarly, the last cash flow needs to be discounted as well, and after discounting all these values, and you come up with $2,808.02. So after calculating the present values, we have plussed all these three values and reached to our conclusion that present value of this annuity due is $2,808. Another way around, if you're not interested to perform this mathematical operation, you can simply write it down in an expression way, mathematical expression way, in this fashion, that 1000 divided by 1.07 raised to the power 0, because this is on timeline 0, so therefore the power will be 0, and this is on timeline 1. It means that it is 1 year apart from our initial today's date. Therefore, the raised to the power for discounting our next year cash flow will be 1. And similarly, this is the second, which is the start of third year. We need to discount it with the power 2, and ultimately we get the same answer as we have calculated by discounting the individual values. This was the first method, which is known as a formula method to calculate the present value of annuity due. The second method to calculate present value of annuity due, this D represent due, is table method. So dear student, there is no separate table in the annexed section of any financial management book regarding the factors of present value of ordinary annuity, factors, present value interest factor for ordinary annuity and annuity due. So I'm just talking about the due factor, that annuity due table does not exist in any book. So in order to overcome our issue, we can simply calculate the present value of ordinary annuity, and then additionally we can multiply it with 1 plus I. This is known as an additional factor, 1 year factor. Its power is 1, because we are actually contributing at the beginning of the time period. So therefore an additional multiplicative factor needs to be multiplied with the present value of interest factor for annuity. This is actually, you can see that this formula is actually belong to present value of ordinary annuity. But in order to incorporate the annuity due factor, we need to multiply this formula with an additional factor, because we have contributed $1,000 at the beginning of each time period. which will be accumulated at its maturity. So the formula is return, which is cash flow, yearly one period apart from each other, equidistance same payment, which is 1000, present value interest factor at 7% compounding with 3 number of years, and this is an additional factor which needs to be multiplied in case of annuity due. Once again, we can find out this factor in table number 4 at the end of any financial management book, and you need to see the table of present value of ordinary annuity. Just find out this compound interest rate, which is 7% in our numerical case, and the time to maturity of this annuity is 3. So you have to select third row, which is actually representing the third year, and then find out the intersection point of these two values, which is 2.624. As I have already explained in my previous lecture, that we are just using the partial table which has been cropped from our main table. However, these value can be up to 50%, and similarly the period may also be up to 50 or 100 years. So just pick up this value, which is 2.624. It is actually the present value interest factor of annuity. Plug it into the formula, and after simple mathematical calculation, you come up with the answer of 2808. This is actually the present value of annuity due in our case. Let's compare it with our previous calculation, which was with the help of formula. Let's go back. The answer was 2808.02. However, with the help of table method, it is 2808. The difference between these two is 0.02. It means 2 cents only. This minor difference, as I have already explained in my previous lecture, but let me tell you again that this minor difference is because of the rounding of these factors we have calculated. We have rounded these factors up to 3 decimal places. So this is the reason that a slight deviation between the answer of tabulated method and the formula method will definitely be there, but we can ignore this slight difference and accept both the answers are correct. Thank you very much for listening to this lecture. If you have any question, feel free to post on KCMS or via email, registered email, and I'll be happy to answer your question. Good luck for the day. Allah Hafiz.